Hi, everyone. Welcome to the Weekend Charts, where I run through the most interesting charts and themes in markets and investing. Another big show for you this week. A lot to discuss. We're going to talk about the inverted yield curve, which everyone seems to be fearing. We're going to discuss the greatest jobs comeback in history. We're going to talk about the unemployment rate and what it means for the stock market and much more. Today's show is brought to you by my friends at Y Charts. Take a look at the show notes for a link to get a free trial to Y Charts and 20% off when you first sign up for the service. I want to start out today by talking about what I've called the greatest jobs comeback in history. And this chart here really tells the whole story. So in March and April of 2020, so during the initial stages of the pandemic, the world was shutting down, and you had 22 million jobs that were lost in the US in just those 2 months. Just an unbelievable collapse that we had really never seen before in history. But since then, we've seen a jobs increase pretty much every month. And now we've added back 20.4 million jobs through today. And that leaves only 1.6 million to go. So the question is this going to continue? Will we see a new high in jobs in the next year? And I think there's a few reasons to be optimistic that we will. And so, number one, if we take a look at jobless claims, which are a leading indicator of the jobs market, they're at their lowest levels since 1969. So you have to go way back to 1969 to see such a low number in terms of jobless claims. And what does this mean? Well, very few people are filing for unemployment insurance. So not many people losing their jobs. That tends to be a good news for the jobs market going forward. And so that's one reason to be positive that the jobs growth will continue. And number two is there's just a lot of job openings in the US. If we look at total job openings, it's around 11 million in the US. And if we subtract the number of unemployed people, that gives us a spread of over 5 million, which we've never seen before. So it's a record high in terms of the spread between the number of job openings and the number of people who are still unemployed. So if you're looking for work, if you're unemployed, or you're looking to switch jobs, really, there's never been a better time to try to find a job than today in the history of the US. So hopefully these numbers will continue and we'll see a new high in jobs in the next few months. Next thing I want to talk about is that unemployment rate. And so what has that been doing? It's really been a round trip in terms of the unemployment rate. And we started here before the pandemic at 3.5%. That was the lowest levels we've seen since 1969. And then, of course, we had that huge spike higher, hit 14.7%. That was the highest we've seen since the Great Depression. And then, of course, the reversal as we've added the jobs back and people have come back into the labor market. We see this number come all the way back down to 3.6%. Today. And so where does that number stand historically? Well, it's well below the historical average, which is around 5.5%. But importantly, we're almost back to that pre-pandemic level, which was a 50-year low. So this is going to give the Fed ammunition to continue to hike rates because part of their dual mandate is maximum employment. So with the jobs market doing so well, and of course, inflation being a huge risk, it gives them more room to be able to hike rates into it as long as the jobs market is strong. Now, talking about that unemployment rate, I think this is a little bit counterintuitive, but if you ask the average person on the street, what does a low unemployment rate mean for the stock market? They probably would tell you that it's probably bullish because we tend to associate a good economy as being good for stocks. So I dug into the data, and this might seem a little bit strange or counterintuitive, but we're actually seeing the opposite situation. So I broke down the unemployment rate into different quintiles from highest unemployment rate to lowest. And of course, now we're in that lowest quintile of unemployment rates. And then I looked at what does the S&P 500 do over the next 1 to 7 years on average. And as you can see here from the chart, from the colors here, the best returns in the stock market actually follow the highest unemployment rates. So following the worst economic periods, you tend to have better stock market returns going forward. And following the best economic periods, similar to what we were in today, you tend to see below average returns going forward. Still positive, but below average. So it's a little bit counterintuitive. I guess the question you might ask is, well, why is that occurring? Why are returns better after worse periods for the economy? And I think it comes down to really sentiment and people overreacting on both sides in terms of overreacting to good news and bad news. So if we look here at this table at the bottom, I think it tells the story. So when investors see a really bad news in the economy and things are pretty bad, the unemployment rate's high, job losses are high, they tend to pay a lower multiple for stocks on average. So this is the average CAPE ratio for the S&P 500 when unemployment is very high. So you can see it's well below the average in all periods. And if we look at unemployment rate when it's really low and what they're doing in terms of the multiple, well, they're paying an above average multiple. So what this basically means is investors become overly pessimistic when the unemployment rate is high and the economy is bad. So they're paying a lower multiple at that point in time for stocks. And the opposite's true when times are good and the unemployment rate's low. So as we know, in the long term, valuation tends to matter, and stocks tend to do better following periods of low valuation than they do following periods of high valuation. So valuation really tells an important story. So the question, of course, is where are we today in terms of that valuation? If we're looking at that CAPE ratio on the S&P, this is a chart, long-term chart of the CAPE ratio. And here we're at around 38. And that's pretty much the highest we've seen since the dot-com bubble. So we're definitely elevated in terms of the valuation. So let's take a look at what happens when you break down that lowest quintile in terms of the unemployment rate and in terms of high valuation and low valuation. So that's what I did in the table here. If we look at periods where the CAPE ratio was below 25, so lower valuations, returns don't seem to be too bad relative to overall returns. And in some cases, they're actually higher. But if we look at periods where the CAPE ratio was high with a low unemployment rate, well, then you tend to see forward returns really weaken from there. So valuation is the important component. The unemployment rate by itself is not necessarily a negative indicator for stock market returns going forward. But if you have a low unemployment rate coupled with high valuations, that tends to lead to weaker stock market returns going forward. And so it's a little bit counterintuitive, but it really comes down to when investors are overly optimistic during good periods for the economy, they tend to pay more for stocks. It tends to be further in the economic cycle. And so you're closer to a period of future weakness. So next thing I want to talk about is wage growth. And so we got an important wage growth number. It was very strong in that last employment report. U.S. average hourly earnings up 5.6%. And if you knew nothing else and you looked at that, you would say that's great news. It's what you want to see. You definitely want to see wages going up. Employees are happy, their wages are going up. And really in any other time period, 5.6% would be a phenomenal number. And you would be celebrating that number and you'd be saying that is indicative of a really strong economy. And that's a good thing for that employee. And the problem is, of course, is that's a nominal number. So it's not being adjusted for inflation. So we're seeing that increase in your wages. But the question, of course, is do things cost more? And of course, as we've been looking at, the inflation rate is moving up pretty much every month. So we have that 5.6% increase over the last year in terms of wages. But the US CPI overall is up 7.9%, and it's still moving higher. So we're going to get an inflation number next week that's probably going to be north of 8% and perhaps even substantially higher. So when you're looking at wages, you have to keep this in mind. And so you have to adjust for that level of inflation. And so I'm talking about a wage growth mirage here because since the start of the pandemic, wages are up a little over 10%. Which again would be a huge increase over a 2-year period and would normally be celebrated. But when we get that March CPI report, it's probably going to show that inflation over the last 2 years exceeded that increase in wages. So pretty much all of the increase in wages since the start of the pandemic is not a function of a real improvement in the average worker in terms of what they can buy. It's just a function of that higher level of inflation. And this really chart here really tells that story. It's comparing wages with inflation. So you really want to be above this line. You don't want to be below it. Below it means that inflation is exceeding the increase in wages. And what we've seen the last 11 months is that wages have failed to keep pace with that higher inflation. So that's likely to continue when we get the March inflation numbers here. And so this is something we really want to see reverse course. This is the main reason why the Fed is hiking rates and expected to continue to hike rates because they need to get inflation under control. So wage growth, the lesson here is wage growth by itself can be good or bad. You want all else equal. Yes, you want wages to rise, but you don't want to be in a situation where they're rising, but failing to keep pace with inflation, which is rising more. So you really have to look at both factors when you're talking about increases in wages. Compare that increase in wages to the increase in the level of inflation. So let's talk about the housing boom. This is really a story that's been repeated month after month, but it gets more extreme really every single month that we see this, because it's continued here. And this first chart here is looking at the Case-Shiller National Home Price Index. So overall home prices in the US, and really every single month for the last 3 years, we've hit a new high every single month, month after month. This is overall, right? There's been some regions that haven't hit a new high every month, but overall, the US housing market has hit a new high every month for the last 3 years. And if we're looking at just the last year, prices are up 19% in the US. So just a huge, stunning increase in a 1-year period. And if we break it down by region, I think this really tells an important story. It's been a rising tide that's lifted all boats. So this is a table showing you the 20 cities within the Case-Shiller 20 City Index. And pretty much every city has seen significant growth over the last year. So every city has increased at least double digits in terms of percentage gain over the last year. And you have some cities like Phoenix and Tampa up over 30% in just the last year. So just a stunning increase. We haven't seen these types of increases, of course, since the housing bubble. And another interesting data point here is we have every single city here at an all-time high in unison. So we haven't seen that since 2005. So of course, 2005 was near the tail end of the housing bubble, where we've seen every single city in the US at the same time at an all-time high. So just really a stunning broad-based indicator. And so I think a lot of people would ask the question, well, maybe I'm better off renting because prices are so high. And historically, that may have been true. The problem is rents are also going up. So as we're looking at the monthly rent here, it's up 17% in the US over the last year. That's the highest increase we've seen in a long, long time. So either way you look at it, the cost of housing is going up and going up significantly. And if we take a look at that rents across the country, where is it rising the most? Well, you probably could guess it's really the areas with the hottest housing market. If we look at the last 12 months, that's really been in Florida. So close to 30% increases in Miami, Tampa, Orlando. Also, as we mentioned, Phoenix, home prices going up significantly, while you're seeing rents go up there significantly as well. So this is going to be a big factor when we get that March inflation report. Remember, I've talked about before, but the CPI is really understating the increase in actual cost of housing. And I think with a catch up with the lag, you're going to have to see that number go up in the next few months. And that should put added pressure on the overall inflation rate, because that housing number is the biggest single component of CPI. So something very important to watch here in terms of the rent pressure. You want to see that abate, of course, because that's going to really impact the overall level of inflation. Last thing here is the question is, well, what are we talking about in terms of what could possibly slow the housing market? Well, as we've discussed, I think the interest rate picture is going to be the most important factor. And here we have the 30-year fixed rate mortgage in the US hitting 4.72%. Just a stunning increase over the past month. It's the biggest increase we've seen in a month-over-month period since 1987. So you got to go back a long time. And this is really impacting affordability in a big way, right? So if you have the same mortgage rate as you did back here in December 2018, okay, well, now you have to compare the level of home prices. Well, home prices in the US are up 40% overall during that period of time. So that means the mortgage payment, that monthly mortgage payment is up 40% since December 2018. And of course, people's incomes haven't gone up 40%. And now you need a bigger down payment for that house as well. So a lot of factors are likely to weigh on the housing market this year. So if we take a look at the mortgage rate in a historical context, this chart really tells an important story. You had interest rates peak in the early 1980s. So this is a 30-year fixed rate mortgage. And then really it was just a 40-year decline until we hit all-time lows there in early 2021. And so this is really a reversal here, huge reversal. But in a historical context, if you went back 20, 30 years and you talk to people, 4.7% mortgage wasn't a lot. But in recent history, if we're looking at the last 5, 10, 15 years, well, now this is above all of those averages. So the highest we've seen in recent history was 4.94%. We might get there this year. We'll see. But it's important to have some context here. We're nowhere near the highest mortgage rates that we ever had. And really pre-financial crisis, so pre-2008, the average mortgage rate was always much higher. So the mortgage rate has gone up, but in a historical context, not very high. And if you compare it to the level of inflation, remember we got inflation at close to 8% and likely to be above that. The mortgage rate is actually relatively low if we're comparing it to the level of inflation. So it's going to be an important factor to watch. I expect it's going to have an impact in the housing market. How much is going to depend on a lot of factors, but it's not something that I think that the market is going to be able to ignore for very long. It has to impact demand just in terms of affordability. If the average person can't afford the average house, you're just going to have a lot less people in the market bidding for new houses. So something to watch, very important for the overall U.S. economy as well, because of the importance of the housing market and people spending, and people's biggest asset is their home. So if they see it going down in value, that's going to affect psychology as well. So the yield curve, let's jump to the yield curve. So, this is one of the most feared indicators for investors, and it's a constant source of concern whenever it happens because it has a long track record of predicting recessions, and we'll talk about that. But here's a chart of 10-year minus 2-year yields in the US. So the yield curve is basically just looking at the spread between different maturities, a longer term maturity and a shorter term maturity. And here we're looking at the 10s minus 2s, which is something that the Federal Reserve likes to look at. You could look at a number of different maturities, but this is one a lot of people focus on. And that inverted for the first time last week with that 2-year yield rising above the 10-year yield. And so, why are people nervous about this? Why is this a concern? Well, it tends to precede economic weakness. So if we look at this table here, the last 6 recessions in the US, we have data with the 2-year yield going back to 76. Last 6 recessions were all preceded by the inverted yield curve. So a yield curve inverts, and then sometime later, a recession begins. Now, here's where it gets a little bit tricky. Of course, it's not an immediate indicator. It's actually a long leading indicator. So there tends to be a long period of time before when that yield curve inverts and when the recession actually begins. So the shortest we've seen in recent history was just 7 months, and that was before the COVID recession in March and April of 2020. It took 7 months before that first yield curve inversion to the start of the recession. But also we have the longest period here at 35 months. So before the 2001 recession, 35 months before the economy went to recession after that first yield curve inversion. So if we're looking at history and we're saying the future is going to be similar to the past, well, we could say perhaps that there may be a recession as early as November this year, but as late as really 3 years from now. So what do you do with that information? I think it's obviously a little bit difficult because there's such a wide range of possible outcomes. But in general, I think that what you should take away from it is there's a higher probability of an upcoming recession. Not that it's going to happen in a few months or even next year, but just that the probability of economic weakness has increased. So the market is telling you something. So in terms of expectations, I put out this poll on Twitter, asking when the next U.S. recession will start. And it seems like a lot of people are nervous today, that with 38% saying that it's going to start this year and another 38% next year. So the vast majority of people are thinking a recession is going to begin in the next year here. And with only 24% saying it's going to be 2024 or later. So the concern is high. I think this would this really this is really an indication of investors really fearing that rise in inflation. If we look at that consumer sentiment data that we've talked about, it's at its lowest levels we've seen in a long time, and it's really at levels we haven't seen outside of a recession. So people are worried. We do have that example in 2011 where sentiment was very bad during a bear market, and then it bounced back. So we'll see. But there's certainly an element here where if enough people fear a recession coming and they pull back in spending, that could possibly cause it, right? So the big question in terms of inflation and the economy is, what's the point at which people will start pulling back in their discretionary spending? So when will they start to say the price increases are too high relative to my increase in wages, and I simply are not going to buy that discretionary purchase, whether it's a car or taking that trip or any number of different things. It doesn't seem like we're there yet. Demand still seems to be very strong, but we'll watch that retail sales data coming out in the next few months to see if any weakness there. And we'll just continue to keep an eye on it. So yield curve is inverted, 10-2. But it doesn't tell you that something's going to happen immediately, as we've seen here. Another important point on the yield curve is the yield curve is not just one relationship. So there's the shortest term treasury we have is the 1 month T-bill, and you can go all the way out to 30 years in terms of the treasury market as well. So you can look at any number of spreads. And this is another one that has really been important historically, which is the spread between the 10-year yield and the very short 3-month treasury bill yield. And as you can see here, it's not inverted. And interestingly, it's actually moving in the opposite direction. It's been steepening. So we've seen the rise in the 10-year yield going up more than the rise in that three-month treasury yield. So if you're looking for a reason to be skeptical, I think, about the efficacy of the 10s-2s today, I'd say this is probably the number one chart you want to look at to say, well, we don't have the situation where both of these yield curves are inverted. So when will this yield curve invert? Well, it's going to take the Fed obviously hiking rates much more than they have been. You still have only one interest rate hike, so the 3-month treasury yield, which really keys off that Federal Reserve policy, still ways away from that 10-year yield. So I think this is an important factor here. Short-term yields are still very low, which means the Fed is still being very stimulative. And in the past, you've seen this yield curve invert as well before you had a recession. So a number of factors go into yield curve inversion. No indicator's perfect. It's something to look at. I think it's an important data point. But we have this situation here where we're not seeing inversion across the board to be skeptical a little bit that signal from the 10s-2 is something to really fear at this point. I think we're going to need to see a rise in that 3-month yield to get more concerned, and it should. If the Fed continues to hike rates, we should see this spread start to narrow. But let's talk about the bond market and what's going on there in terms of interest rates. We're just seeing that stunning rise really continue as the expectation of Fed hikes really increases. So people pretty much month after month this year, the expectations for more aggressive hiking by the Fed has really increased with the increase in the rate of inflation and with the unemployment rate doing very well, going down. It's really, people are expecting the Fed to be more aggressive in terms of their tightening policy, and we've seen that translate into higher interest rates. So pretty much across the board, interest rates still rising. This is 1-year treasury rate to 30 years. And we're seeing the highest levels we've seen in a few years. And you can see the tightness in the spread here. And this is where the inversion is going with 5 years, 10 years, 30 years. That's pretty much where the inversion's occurring. And then the 1-year yield, like the 3-month, is not yet pushing above those longer term rates. So what is this doing to the bond market, this rise in yields? Well, as we talked about, this is going to be, we're on pace for the worst year in history. But what about longer term drawdowns? I went back and looked at the Barclays aggregate, which is the bond index that goes back to 1976. And I said, well, let's look at the monthly data and see what was the longest drawdown in history. And lo and behold, it's what we're in today. So you have 20 months now of a drawdown for this Barclays aggregate index. That's the longest in history. The prior record was 15 months in 1980 to 1981 when you had that huge spike in interest rates and inflation. Now we've exceeded that in terms of duration. The magnitude at 7.6%, this is through the end of March, is the highest we've seen since 1980, 1981. So pretty much the worst bond bear market that recent investors have seen. Even people that had lived through 1980 and 1981, now this is really longer than that, because the interesting thing is back then you had the interest rate so high in 1981, it was at 15%, the 10-year treasury yield, that you were getting so much yield that any decline in interest rates would lead to a huge spike in prices. And that's what we saw 2 months after that bottom in 1981, the bond market hit a new high. We're in a different situation, of course, today. You have the 10-year at around 2.7%. So it's going to take some time before we get a full recovery in the bond market, even if the low is in today. So just a difficult period for bonds. This was really inevitable because we're starting with the 10-year yield at 50 basis points, lowest in history in August 2020. And the only really path to higher returns for bond investors was going to be painful. And that's what we've seen. So next week, I'm going to talk a little bit more about the relationship between bond yields and future returns and why this increase in bond yields over the last 2 years is good news for people that are just coming into the bond market and looking at it today. So it's been a very difficult drawdown if you've owned bonds with any duration, but if you're coming into it and looking at it with a fresh set of eyes, this is going to be better for a longer term return. So we'll discuss that in next week's report. Last chart here on the Fed funds futures. This is very important here. Investors are now expecting, so this is a probability chart showing you the expectations for June 2023. So a little over a year from now, investors are now expecting a 62% probability of a Fed funds rate between 3.25% and 3.5%. So just a stunning increase from where we are today. Remember, today we're at 0.25 to 0.5%. So market is expecting a 3% increase in short-term interest rates a little over a year from now. So that's just a dramatic increase. Will it happen? That's going to depend on a number of factors, obviously trajectory of inflation, how the economy is doing, and so on and so forth. But the expectations are that the Fed is going to try to get inflation under control, and they're going to be very aggressive in hiking rates over the next year. So let's talk about the king of Twitter, and that, of course, would be Elon Musk. So Elon Musk in the last week of March put out 2 interesting polls on Twitter. The first was asking about free speech. So there's been a lot of concerns in terms of Twitter not allowing really free speech and shutting off people or banning people that don't share opinions that they like. And Elon Musk put out this question: do you believe Twitter rigorously adheres to the free speech principle? And of course, the answer here, most people said, is no, which is very interesting. And then he asked, should the Twitter algorithm be open source? So should the way you see things in your timeline, should people be allowed to see how Twitter is arriving at that? So there's been a lot of speculation that Twitter pushes certain information that they want to push, and that they should reveal how that how the algorithm actually works. And so people seem to be in favor of that transparency. So a number of people are asking, why is Musk doing this? Obviously, he's very important, to Twitter. He's one of the most followed people on there. He generates a lot of conversation around Twitter. And so people are wondering, is he going to start his own social network? And he's talked about that in the past, but instead what we saw this week was that Musk actually took a stake in Twitter. So he bought a 9% stake in Twitter. He's the largest outside shareholder now of Twitter. And the response from the market was pretty incredible. So we saw Twitter stock price go up 27% in a single trading day. We saw the highest volume day in history for the stock, and we saw the market cap go up by $8.5 billion to $40 billion. So at least in the short term, investors seem to be betting that Musk is going to bring change to Twitter, and that change will be positive. He's already put out a poll in terms of editing your tweets, having an edit button, which really has been a source of complaint from a lot of Twitter users. If you make a typo, you have to delete the tweet. You can't edit it. And Twitter's just been resistant to make that simple change. And it seems like now with Musk there, and they actually gave him a board seat, that's going to change. So remains to be seen. Musk is obviously a busy guy. He's got a lot of other things to worry about and projects, but he seems to believe, as do I, and as do most of us, that Twitter's pretty important to the social discourse in America. To have free speech there is pretty important. And so if he can bring that about or help that, I think rather than starting a new social network, that would be great. And so can he do that? I don't know. I don't think anyone knows, but if anyone can figure out how to improve Twitter, which obviously, if you look at its stock price over the years, they haven't been able to obviously monetize it or improve it enough where it's led to a gain for shareholders. If anyone could figure that out, it would probably be Elon Musk. So something interesting to watch. I think it's really a net positive for anyone on the platform. And so we'll see where that goes. But I'm hopeful that it'll lead to an important change. And you need, obviously, rules and regulations. You can't be posting things that are illegal or making threats to people. So there needs to be some level of control. But I think the overall opinion is, as much as possible, promote free speech, even if you disagree with that speech. So you want to defend people, even if you disagree with their opinion, they should have the right to say it, as long as, again, it's not breaking some law. So we've covered a lot this week. I want to thank everyone for joining me. Have a great weekend, everyone, and we'll see you next week.